All right, let's jump right in. We're going to cackle a really fascinating puzzle, something that feels completely counterintuitive. How can massive government debt feel totally fine for years, even decades, and then, suddenly, it all just falls apart?
You see these headlines all the time, right? Staggering figures for government debt. Numbers that, honestly, would have sent people running for the hills a few decades ago. But the weird thing is, markets are often just calm. It's kind of eerie. So that's the big question, isn't it? Why does this massive, obvious risk not seem to matter? Why does everything feel okay, right up until the moment it's a total catastrophe? Okay, so the core of the problem, it's really all about how we think about risk. Our brains are kind of wired to assume risk is linear. Like a bathtub filling up. You see the water level rising slowly, you have plenty of time to turn off the tap. But that's not how this works at all. Sovereign debt risk is what you'd call nonlinear. Think of it more like an earthquake fault line. The pressure builds up silently, invisibly, for years, and then, bam, the break is sudden and it's total. And this is what creates this really dangerous illusion of manageability. Every day that goes by without a crisis feels like evidence that everything's fine. Bond auctions go well, interest rates stay low, and we all start to think, well, if these crazy debt levels haven't blown things up yet, maybe the old rules just don't apply anymore. It's a powerful bias. And that very belief, that false sense of security, is exactly what allows the real risk to just keep building up under the surface. So how is this illusion kept alive for so long? Well, it turns out there are three really powerful structural tricks, you could say, that governments use to delay the day of reckoning, sometimes for decades. So you've got these three pillars: the credibility buffer, narrative control, and delayed market discipline. And it's important to remember, they don't actually solve the problem, they just hide it. They work together to keep up that appearance of stability while the real pressure just keeps building. Let's start with that first pillar. It's not really about the numbers on a spreadsheet. It's about something much more fundamental: trust. Simple, old-fashioned institutional trust. See, when investors lend money to a government, they're not just looking at its ability to collect taxes next year. They're betting on the credibility of the entire system. And this credibility isn't just some vague feeling. It's built on real, tangible things. Is the political system stable? Can you trust the courts and the rule of law? Can the government actually collect its taxes efficiently? And is the central bank independent and, competent? As long as the answer to those questions is yes, investors feel like the adults are in the room. And that massive reservoir of trust is what lets a country borrow way, way more than the raw numbers say it should be able to.
Okay, pillar number 2. This one is all about storytelling. Because governments know that markets run on trust and perception, they get really, really good at narrative control. When the debt numbers start to look a little scary, they roll out these very specific, very comforting stories to manage expectations and, well, buy more time. And you've probably heard these before. They're the classics. The first move is to say, hey, don't look at the total mountain of debt. Just look at the tiny interest payments. Rates are low, so it's totally affordable. The second one is the promise of a brighter future. Don't worry, we're going to grow our way out of this. And the third, and maybe the cleverest, is to just kick the can so far down the road it's someone else's problem, like by issuing 50-year bonds. All right, this brings us to the third and maybe the most important pillar of all. It explains why governments can get away with all this for so long. And it's perfectly captured in this simple quote. Think about it like this. If a company, or you for that matter, gets into too much debt, your creditors can force you to deal with it. They can make a margin call, demand you sell assets. They can force a reckoning. But for a sovereign government, especially one that prints its own money, there's just no one who can do that. There's no repo man for a country. No one can show up at the Treasury and say, okay, time to sell off Yellowstone National Park because your debt to GDP is 150%. And because there's no immediate trigger, the problem can just keep getting bigger and bigger for years.
So this is where it gets really interesting. If all these risks are so obvious, why do smart, rational people, investors, policymakers, let it happen? And the answer isn't that they're dumb. It's all about incentives.
Let's look at it from the investor side first. For a professional fund manager, being early on a crisis is a disaster. There's this huge career risk. I mean, if you're right just before it happens, you're a genius. But if you're right too early, you're just fired. Just imagine this for a second. You get nervous, so you move all your clients' money into super safe, low-return stuff. Meanwhile, all your competitors are still riding the wave. What happens? Your fund's performance tanks compared to the benchmark.
Clients get angry, they pull their money, your boss fires you, and you were right. You were just right at the wrong time. And this creates this totally perverse but completely rational incentive. It is far, far safer for your career to be wrong with everybody else than to be right all by yourself. You stick with the crowd. And by doing that, every single rational fund manager reinforces the very illusion of stability that is creating the danger in the first place. It's a feedback loop.
And for policymakers, ma'am, the incentive trap is even worse because it's driven by election cycles. Look at the choice they have. Option A, kick the can down the road. The immediate benefit? You get to spend money, keep taxes low, make voters happy. It's a clear political win, right now. The cost? Some abstract risk for the next generation. Option B, fix the problem. The benefit? Some abstract economic stability 10 or 20 years from now. The cost? Immediate, painful austerity. Tax hikes, angry voters. I mean, if you're a politician who wants to get reelected, which one are you going to choose? It's not even a close call.
So look, if we accept that everyone involved is basically trapped by these incentives, then we have to change our whole approach. The goal can't be trying to predict the exact day the crisis will hit. That's a fool's game. The real goal is to understand the nature of the risk itself so we can be more resilient. And this leaky roof analogy is just perfect for it. Deferring risk, all those narratives and delays, that's like constantly running around emptying the buckets under a leaky roof. It feels like you're doing something, it keeps the floor dry for now, but you haven't fixed the actual problem. Eliminating the risk is actually fixing the roof. It's hard, it's expensive, it's politically painful. So the big takeaway here is that when you see stability, you have to ask yourself, is this a strong roof, or are they just really, really good at emptying buckets? And this leads to a really profound and honestly kind of scary paradox. The time when everything feels the most stable, when government debt is a boring topic no one talks about, when yields are low and everyone's complacent, that is almost certainly the moment of greatest danger. That calm isn't a sign of safety. It's a sign that the deferral tricks are working so well that all the pressure is just building up, completely out of sight. Okay, so let's wrap this all up with 3 key takeaways you absolutely have to remember. Number 1, this stuff doesn't unwind slowly. Government debt crises are fast, they are non-linear events. Number 2, stability is a mirage. That calm you see is just delayed discipline, it's not real safety. And number 3, and this is the most important one, you have to focus on the incentives. If you understand why people are trapped into making these choices, you understand the whole game.
So this whole framework really forces you to look at the world differently. And it leaves us with one last question to chew on. Just look around. What looks totally, completely stable to you today only because it hasn't been hit by the right kind of shock yet? Because whatever that is, that's where the real risk is hiding.